right. So thank you again for joining us on our third episode of the Altyverse. Today, I have the pleasure of having Kenny Peskin here from Champions Mortgage. And today we're going to be talking about deals most lenders say no to and how Champions turns them into closings. Sometimes it'll be seasoning issues, sometimes it'll be gift funds, or it may just be like a rural or agricultural property. So Kenny, can you give me an example of one of your spiciest deals that you guys are able to do that other lenders just can't hack it at?
Actually, I can. Thanks for having me on. We actually had a really interesting customer scenario that came across our desk 2 weeks ago. And basically what it was we had a 2-family primary residence property. And this nice woman was a senior citizen. She was actually looking to get a cash out refi to pay for her college tuition for her grandchild.
Yeah.
But the problem that we had with that customer was that she hadn't worked in about 25 years. And while she was very good at paying her mortgage, she was delinquent on many of her other credit cards. So her credit score actually was a 590 or a sub 600 FICO. But what we definitely had was a customer that was paying their mortgage, and we had a strong LTV, but she didn't qualify in any other way. But what we're able to do in our organization is we don't have any seasoning requirements, traditional seasoning requirements. So what we did was we listened to the customer and we identified through conversation that in this 2-family, her adult son was living in the upstairs unit. He had just moved in. I think it was 4 months earlier. So he had established his primary residence on that on the second unit. We quick claimed the son onto the property, taking mom off the property, and then we did a P&L loan, a profit and loss loan on the adult child, the adult son, so that he can qualify to do a cash out refi using a P&L, going off the appraised value on this 2-family. And the LTV and everything else worked out. So we were able to get the customer the cash out that they needed. So we were able to leverage a P&L product, a seasoning issue, and we were able to use the customer didn't even have a CPA or enrolled agent. They used a traditional tax preparation company that had a P10. So we were able to leverage a whole bunch of little things that we incorporated into one scenario that really changed the impact for a customer there.
I think I heard like 3 to 5 different things that could have disqualified that loan at a lot of other non-QM investors. So that's a perfect example. So now this guy, the son, was used P&L. So was he self-employed, I assume?
Yes, he was self-employed. He was a contractor, and his deposits were not always in the same accounts all the time. So there was some inconsistency in there. But he had a tax preparation company that he's done business with. So he went to that tax preparation company. They were not CPAs and enrolled agents, but he brought his 2 years worth of income and expenses. And they did an unaudited profit and loss. There was no bank statements even required to support the income. We used the 12-month rolling P&L from the accountant. We got a letter of attestation from them, and we were good to go. So that worked out great. And of course, being able to go off of the actual value of the house and not the acquisition cost was a key to making this work because there was so much equity in there.
Yeah, no, that's awesome. Yeah, I mean, I can tell you, like, I think you guys may be the only place that would have done that loan the way you described.
Yeah. And and the LTV was low enough, meaning that it was the LTV was only like 60 or 65. I don't remember the exact number, but it was 65 or below. And at a 65 or below, we have no cash out limitation. So they actually took out as much cash as they wanted because I think the value of the property, it was a New Jersey property. I think the property was valued at somewhere around $2 million. So there was a lot of equity in there. She only owed like 150 at the time.
And the equity was trapped, for lack of a better word.
The equity was trapped, and she had no way of getting it out. And as somebody that's got more than his fair share of kids in college, I can totally appreciate the stress of having to pay for college and not knowing where the money is going to come from. So it was a great thing that we were able to get not just 1, but 4 years of college out in one shot for this customer. They were very grateful.
That's awesome. So, well, thank you for that. I'm sure there's going to be a ton more examples of why, Champions is so different. And really, I'm sure a lot of it comes down to the knowledge and the experience that you have and some of the other account executives throughout the organization, just bring to the table and really add value to those out there trying to originate and fight to live another day and get another deal, right? So thank you for that.
Yes.
So, Kenny, I'd love to learn a little bit more about you. Obviously, I've known you for 15 years, maybe longer. I've known you as, a leader at many different non-QM banks, but also I'm sure agency prior to that, before non-QM existed. Now being at Champions, I'd love to learn a little bit more about your role, and a little bit more about Champions and the philosophy, maybe as it pertains to non-QM, if you don't mind just sharing a little bit.
Yeah, no, absolutely. I appreciate that. Yeah, we've known each other longer than I care to admit. Just means we've got a lot of experience. So
I'm wearing a hat to cover, my hair.
Yeah, that's right. That's right. So listen, my role in the organization is I'm an EVP of sales in the organization. I'm predominantly responsible for the Champs East division. And our philosophy actually is quite simple, which is that, this is all about solutions-based lending. So we as an organization, we as a division, we take a very different approach. So Champions as an organization has a very can-do solutions-based lending attitude, which is reflected in our ability to look at loans and look at them very differently. So, will we do the main, that fairway loan program? Yes, absolutely we will. But what we're going to spend a lot of time with you on is looking at a loan that other people don't understand how to fix. And within our department, within our division, we really incorporate a combination of the best of both worlds. So we're going to take real old school ways of thinking, right? We're going to talk to you. We're going to talk to your loan officer. We're going to listen to that story. We're going to listen to every unique component of the scenario that your customer has. And through those conversations, we're going to hear them and we're going to pull out the solution. So, for example, my first scenario, we're talking and we're hearing that this woman has a 2-family and she needs to pay off college tuition for a child. That tells me 2-family, there could be other, and that there's a family members going on that they're trying to support. That means there's an adult child. That means there's other things going on. And based on those other cues, we're going to ask questions. And through those questions, we're going to leverage the different products that we have that are unique to us. And that's where this solutions-based lending comes from. So our methodology is simple. Email, text, or call us. Let us talk about the loan. Let us understand what is going on in that loan and where the uniqueness of the customer is and where that challenge is. And then what we're going to try to do as much as everything is, our goal is not to provide one solution. Our goal is always to provide 2 or even 3 solutions. Now, the first solution may be significantly better than the second, which will be significantly better than the third. But what we have learned within the organization in our time doing non-QM lending is the more solutions that we can provide a loan officer, the more confidence that they're going to have. And that confidence gets translated down to the whether it be the realtor referral partner or the end consumer. And that confidence is what helps everybody sell a loan. And we take great pride in trying to give that confidence through education.
So everybody's talking about AI these days and how AI is going to replace. I mean, I just heard what you said about listening to, the story, pulling out, okay, well, if it's for college tuition and this is a grandmother or an elderly lady, then there might be an adult child. Like, I think it's safe to say that hands-on, pick up the phone, like you said, call, email, let's just talk through it is going to continue to be a need in this non-QM space. No matter how hard we try to put AI into this, there's going to be that element where, almost like a manual underwrite, right? Where you just need to talk through it. You need to understand all the moving parts and then, come up with a solution. So that's awesome, man. So let me ask you this question. This is something that's really important, I think, because so many of loan officers they're just afraid of non-QM. They don't want to learn something new. Maybe they're lazy. I can't imagine they don't want to make more money. So I can't it doesn't make sense to me. But if you're talking to me today, you just met me, and you're new. Champions is a new investor that my company has, and I don't know anything about them. And I'm saying typically I'm a conventional loan officer, 5%, 20% down. I know how to navigate Fannie Freddie. That's my wheelhouse. What's something that you would impress upon me, or a misconception that you would try to fix? Because I'm sure you run into this person all the time.
Absolutely. I mean, it's a great question. It's a great point. We do see it all the time. My belief system has always been that, when you're right, you never want to leave money on the table. And every loan officer is looking to maximize their dollars at every cent, at every point. Now, why does a loan officer not leverage an opportunity that exists? My experience has been, to your point, Gabe, that it revolves around fear. And the fear is of the unknown. I'm a referral-based loan officer, and I don't want to ruin a relationship. I'd much rather walk away from a loan than take a chance on something. And there's that experience issue that they don't know what the outcome's going to look like. So what I typically tell people is this: we, in our division, in our business here, we make money the same way a traditional loan officer works. So you are my referral partner. Your referral partner is the realtor, the accountant, whoever it might be. We're sensitive to how your referral partners work. That's how we work with you. We take tremendous pride in being able to walk a loan officer through every loan. So whether it's their first or their 400th loan, we will walk the loan officer through every step, and we will not let them make mistakes. There's enough guardrails that we put in place that a loan officer cannot get too far down the path of where they go to the point of no return without us being able to talk with them and identify what's going on. So we put a lot of guardrails in place and spend a lot of time giving the loan officer the opportunity to talk to us and let us educate you on the opportunities. So the biggest question that really where this comes down to is, when we're not a Fannie or Freddie lender, which is what we're not, but so the biggest difference is Fannie and Freddie, you're a full doc loan. You have tax returns, you have W-2s. That's about the extent of it. You've got one or two income levers to pull. We don't. Our income levers are well beyond that. Yes, we can do W-2s and tax returns. We can do W-2s without the tax returns, but we also can do bank statement loans, whether it be personal bank statements or business bank statements for self-employed, 1099 loans, P&L loans, asset depletion loans. We have no income loans for primary residents, no income loans on DSCR for investor loans. So the point I'm trying to make to you is the difference is you have one lever to pull in Fannie and Freddie. We have 10, 15 different ways of looking at a loan to chop it up to get that customer to qualify. So the best thing that I say to anybody is, if you think you don't have a loan, that's great. Email, text, or call us. Tell us the scenario. Tell us the story. Our approach is that every loan has a solution. That's how we look at it. Every loan has a solution. All you have to do is talk to us, tell us the story, and we'll show you solutions. Now, not every solution will fit your customer specifically, but it's important to understand what those solutions are, because what's going to happen with your customer is, while they may not work on that particular loan, what your loan officer realizes from the dialogue is, hey, this is good for the next loan or the loan after that, or gets me more confident to speak to my realtors, or say, I can do a sales presentation on first-time home buyer, first-time investors with realtors, where they never would have thought they could. But now after conversing with us, they have opportunities in education, and they see that we can help them even with things of that nature. So it's really just the education that stands up, where we stand out. It's the education and the time that we take to speak to your loan officers to understand what they need.
And I think that's probably the biggest thing that's lacking in the non-QM space is a education platform, right? That's really our thought process, or really our thought as to what the Altyverse could possibly serve, is to help bridge that gap and give a resource, or a community where people can get answers to questions. And I gotta say, Champions is going to play a huge part in it. I'm not going to put words in your mouth, but you guys are definitely changing, in my opinion, the world, the non-QM space, right? I think
Yes.
the idea of how you problem solve, how you can just take a common sense approach and really dive into things and try to find answers. One of the things that I remember that was really cool, at least from my perspective as an originator, was Champion's take on credit depth, right? So talk about agency, right? DU isn't going to score if there's not enough depth, right? Or there may be requirements if you got to do a manual underwrite and on a government loan. One of the things that I thought really stood out was Champion's take on credit depth. Can you share a little bit about that? Trade lines, thin credit, things like that.
Yeah, sure. Yeah, that's a great point. So we do, and that's a testament to the CEO and of our organization, Evan Stone. He's very proactive in terms of being an out of the box thinker, and he's been very, very thoughtful about those things, and we've been able to leverage that. So it's been a wonderful thing. And so the way that we're looking at credit here is, some of our more basic elements are still more flexible, because we'll do 2 trade lines for 12 months, 1 for 24. We'll also do 1 trade line for 12 months, and that will be enough. But we're also offering, if your customer has 3 credit scores and no active or no trade lines in many cases, that's a customer that we can do a loan for as long as they have three credit scores. Now, taking that a step further, if you have ITINs, ITIN customers, we're very aware of how ITIN customers work and sensitive to that. So we have customers that are ITINs and they have no credit at all, no FICOs, and we can work with that. And the same thing holds true with foreign nationals. So to your point, we take a very intelligent, common sense approach on credit. Additionally, what we're going to do is we're going to allow you to work on the credit while the loan is in process. A lot of times we hear from loan officers and they're like, we want to submit the loan, but the credit score doesn't meet the requirements for the loan program that we want to give you. And my response to them is, that's okay. Maybe you're not going to get the maximum LTV that you want today, but as long as we fix the credit between now and prior to closing, we can allow you to redo that credit, redo the credit scores, and we're going to give you the benefit of the higher credit every time, and allow you to qualify at that next level. So
I assume you need to document, where the funds came from, if you paid down debts, things like that. Just like, it's not just as easy as, hey, now my score's a 700, right? There's going to have to be some documentation to show that trail, I would assume.
Sometimes, yes. I think it depends on how it's being handled, but sometimes we're going to look for, listen, it is common sense lending at the end of the day, right? So no one's ever taking a blind eye to anything, and that being that, we're going to take a common sense look. We're going to take a responsible credit lending look at everything, because, obviously performance and the protection of an industry that's so dynamic and so wonderful, we want to make sure it's here for the long term, because ultimately that is the most important thing for all of us. But we're going to be very aggressive on all the things that make sense. We're going to be very aggressive on all those common sense things that make sense, as long as it makes sense and it's something that we can get behind.
Yeah, I mean, I think one of the things that also jumped out at me with Champions is, I used to think the non-QM space was for self-employed, experienced, I used to say my father, but I guess maybe people my age as well, right? But there's definitely it's a product, and especially at Champions, it's an offering to help first-time home buyers, even first-time investors, right? Like, I used to think that this is something for that person who's got high net worth, good credit score, big down payment, a lot of equity.
Yeah.
This is an alternative way. They don't want to pay a lot in taxes, so we'll use the bank statements, we'll use the P&L. But in reality, Champions has products that, like you just said, you can improve the credit in the process, right? First-time home buyers. I mean, tell me about like seller contributions, gift funds, even like living rent-free. Like, those are some things that jumped out at me that I'm like, wait a second, like this exists here. Champions will do this.
I know. It's fun. It's we've taken a very holistic approach to how we take a look at the business, and you're not wrong, Gabe, in everything that you're saying, which is that the world has changed. We are now surrounded by gig workers. We're surrounded by Gen Z and a whole new way of life and how people live. Historically, over the previous 30 years or so, investors were people that were like your father, right? People that have a lot of experience, and they're seasoned investors in many cases. But the world has changed, and we as a company have been very proactive in addressing the changes and coming up with solutions for the markets that exist today. So one of those things is that there's been we see cultural shifts about how people approach home ownership. Home ownership now is, we grew up as first-time home buyers. We're buying a primary residence, but that's not the case anymore. We see lots of 20-somethings that are first-time home buyers that are living with their family, rent-free, and they want to buy a house, and they want to put 20% or 25% down. And they've never owned a home before, so they're first-time home buyers, and they want to buy their first home as an investment property. We can address that. We understand what the markets are shifting and addressing, and we're here to address the shifts in the market, and our products are flexible enough to do that. So we can take a customer that's a first-time home buyer, first-time investor. They've been living with their family. They own a business. The business, we can either use tax returns, profit and loss, bank statement loans for that customer, and we can have them purchase that property. If they don't want to use traditional debt to income ratio loans, we can do the loan as a debt service coverage or a DSCR loan, which is a wonderful alternative for many of these customers, which actually is many times the most preferred method because it promotes the easiest solution. And the reality is the rate difference between the DTI loans and the first-time homebuyer DSCR loans are not significantly different enough to warrant the additional efforts in many cases. But to your point, we'll also allow for seller contributions on these loans. And we'll allow that seller contribution on first-time homebuyers, seasoned homebuyers. It could be primary. It can be an investment property. We're agnostic to that. 6% seller contributions on any of these loans at all max LTVs. So theoretically, you could be a first-time investor putting down with the maximum loan to value, 85 in many cases, with a 6% seller contribution, assuming you qualify. But these are the types of things that we can do.
Right.
And again,
DTI is a little tight, right? Let me give you another one. DTI is a little tight, but you got mom who's got low debts, and she has some income. Non-OC co-borrowers, how does Champions feel about those?
Yeah, we're happy to use non-owner occupying co-borrowers.
All right.
And we'll always use non-owner occupying co-borrowers in almost all cases. But what I would suggest also is whenever I hear there's a DTI issue, I know that adding a non-owner occupying co-borrower is always an emergency break glass, right? That's the last thing that every customer wants to do. So we're extremely sensitive and aware to that. So what we'll always do is we'll do what we do best, which is we're going to ask you questions. So when you say the DTI is a little high, right? My first question is, well, what do they do? Are they self-employed or are they a wage earner or both? Because we can commingle multiple product lines across the board. So you may be a wage earner, and then you tell me that they're in the union as a teacher and they've been on the job for 15 years. Well, that means that they have assets. So maybe I can combine the assets on an asset depletion with the W-2 wages, and I can put together a loan that way.
Yeah.
Maybe you're telling me they're self-employed and you've already done the income analysis, but you base the income analysis on a 50% expense ratio. Well, our expense ratio defaults to only 25%, which means that our expenses are literally half to what the competitors are. So if your DTI was at 55, when you do a bank statement calculation with us, there's an excellent chance it's going to fall below that 50. So I guess my answer to you, Gabe, is there's always a solution. And before we jump to the solution, our goal is to ask enough questions to give you the options that you need to put the customer in the best light possible.
All right. No, that's awesome. You guys are really doing some amazing things. So before I get you in the hot seat and start just rifling off little scenarios at you, and I'm going to ask you, you got to put your credit hat on, your non-QM credit hat. If you were going to talk about, you do a new sales presentation to a new seller or a new broker, relationship. What are the top 3 products that you think, because it's like drinking water out of a fire hose, right? Like all these products, all these different things. It's like, where do I start? And that might be part of the barrier for these conventional LOs, is just trying to digest it all, right? So if you could just take out top 3 programs, products, whatever you want to call it, at Champions, and just real briefly, what the program is and why they need to know about it.
Absolutely. A great question too. So I would say our first best product that most people think about is our Ally program, which is our primary second home no ratio program. That program is an amazing product, the way that it works for us, because it works as a Swiss Army knife in a lot of ways. So because it's a primary second home, it creates tremendous flexibility. There's no income requirements like a DSCR loan, where there's no DTI, there's no employment information. It's based on FICO, LTV, reserves. You're off to the races. You can work with that loan, no problem. It's great on cash outs. It's great on it's great on purchases, because you also use gift funds. So it's a really flexible product. It's amazingly unique. And if I wanted to go out and create referral partners or relationships and maximize it, talking about a unique product like a primary second home no ratio product that can also be done in rural areas, which also has a lot of other unique components surrounding asset type, meaning like you could use it for daycare centers, primary residence daycare centers. The program works for some unique properties like log cabins in the right marketplaces, luxury log cabins. So there's a whole bunch of ways to using the program that's really unique. That's a primary residence program. The P&L program, most people look at that as an amazing opportunity because it's great for primary, second home, and investment properties. It goes to pretty much almost every LTV that we offer. There's a no seasoning component attached to it, which people love. Again, the P&L component, that it could be from a CPA enrolled agent, a P10, and it could be from a tax preparation company that, even if they've never filed tax returns before, it's a wonderful way of solving for loans that are challenged in terms of traditional income documentation. And that's unique because we can do it for all loan programs.
Now that one, so usually when you do a P&L, at least in my experience, a lot of your peers and your competitors, they're asking for 1, 2, 3 months of bank statements, or to support that direction or support that P&L. Is that something you guys require on all files as well?
Right, that's a good question, and the answer to that is we do not. So while we do offer it as an option for enhanced pricing, which we're always going to look to offer you, again, we go back to solutions-based lending, and we understand that lots of self-employed people are going to a tax preparation company, and we understand that a lot of self-employed companies have no need for a CPA or enrolled agent. They're just looking to file their tax returns. So we don't want to lose the opportunity of doing business with a highly qualified individual just because they're choosing to use a tax preparation company that is not accredited to the same level because they don't need it. So if I own a bodega, right, what do I need? I don't need a CPA. I need to file my tax returns, right? There has to be, not every organization is required to use a CPA for business reasons. So we don't want to lose our opportunity of those good businesses and those good customers. So we're going to be very flexible on that. Bank statements, that is not a requirement. So bank statements are not required.
Right? You want enhanced pricing, show them, but they're not required.
Absolutely correct. So if you want better pricing, you can give it to us. But if you don't have it, that's okay. We're going to work with you on it. And there's no LTV restrictions and FICO restrictions as a result. It's just a pricing enhancement.
Got it. All right. So now for that third product, I heard you say the word before, 4-letter word acronym at ITIN, right? So tell me about your ITIN program, because I got to assume that's the third one you're going to talk about.
Yeah, absolutely. So our ITIN program is a very robust, intelligent program. Again, we took the time to really understand the customer base, that we deal with. So I-10 customers for us are some of our favorites because we can do owner-occupied programs, we can do purchases, and we can do rate and terms and cash outs for all of these customers. And we're going to give that I-10 customer complete access really to all of our loan programs, which is a little unusual. So and many of these I-10 customers are self-employed borrowers, right? So we'll allow them to do bank statement loans. We'll allow them to do our P&L products. We'll allow them to do 1099 products. Of course, we'll allow them to do W-2 and full doc products to the extent that that's what they are. We also offer, which is really unique on the I-10 program for the wage earner, we offer a VOE only program, okay, which is really tailor-made for the I-10s in most cases. So if they're not self-employed, they tend to be a wage earner, and maybe their wages are not always documented 100%. Some are on the books, some are off the books. So we have for the right qualifying customers, we'll do a VOE only. Customer has to be working on the same job for at least 2 years, and we'll take a Fannie Mae style VOE. We will look to see 2 months worth of bank statements to see 65% of the stated income on the VOE is being deposited. So we're not expecting. So we understand that there's, leakage, if you will, in terms of what's showing up on the bank statements compared to what they're actually earning. So we account for that. So we'd be very flexible with that I-10 customer. Additionally, on the I-10 customer, we'll also let them do investor loans as a DSCR. So that's another unique thing. So people love our owner-occupied flexibility on the I-10s. They love our DSCR for the I-10s. We're going to work with the limited credit for those I-10 customers because we understand that as well. So yeah. And then I guess what I would say to you that, to your point, like, is it product or is it guidelines? And it can be confusing because our no seasoning works on virtually every loan program. Not our primary no ratio program, but it works on every other program. 100% gift for down payment and closing costs fundamentally works on all of our programs. First-time home buyer, first-time investor fundamentally works on almost all of our programs.
So to your point, it's not program, right? Because you have the program. You might have the same programs that your competitor down the street has. It's the credit policy and the underwriting guidelines and the interpretation of what common sense is and what risk is and what risk isn't, right?
That's absolutely the case. I mean, and when you take a look at our DSCR loan program, nothing is more obvious than that within the DSCR programs, because obviously we're going to do 100% gift for the down payment and closing costs. They can be first-time home buyers, first-time investors. You can do maximum seller contributions. We can do all of these different things. But what we're also going to allow you to do is we're going to let your customer have a property that's vacant on the rental, and we're going to go off the regular DSCR with no limitations. What we're also going to do is we're going to take a common sense approach. A lot of the times a property is being refinanced or bought, and it's an investment property, and the property has been rented for the last 10 years, and it's fundamentally under rented. And the marketplace says it's under rented. You have to go off of the under rent amount, not the market rents. We will allow you to go off of the market rent or what the 1007 says, regardless of what the actual rents being collected are. So again, we're going to take a lot of these different types of common sense approaches.
Yeah, no, I mean, I almost want to say, hey, if you haven't met Champions yet and you have a loan at another non-QM outlet and they say no, bring it to Champions before you just put it to rest, right? Like, give Kenny a call, let him check it out and see what they can pull together there.
Well, so, I appreciate that. What we take great pride in is we say if the loan doesn't qualify and you don't know what to do, email, text, or call us. Yeah. And if you think the loan qualifies for something, extra email, text, or call us. Because our goal is to make sure that we're putting you into the best possible product. And even though you may already be there, it's great to know that you have 2 or 3 other options, because confidence wins loans. That's what we've learned. And we want to be a confidence-inspiring opportunity and tool for every loan officer that you work with.
So I warned you. I want to shift us into a scenario laboratory here, right? So I want to give you throw some scenarios at you. If you need me to repeat them, I know I haven't given you much prep here, but I just want to ask you, what does Champions think about this, right? So First one, if you're ready. So an investor bought a piece of property 30 days ago. There was some, minor updates they want to do, maybe paint, maybe some new upholstery or something. They just want to doll it up a little bit, paint, maybe a upgrade in the kitchen. Nothing too crazy.
Mhm.
25 grand.
Yep.
They bought it for, let's say, 300,000. They put 25 grand into it. That's probably not realistic. They bought it for 4, put 25 in, and they got a great deal on it. So now if it appraised today, 30 days later, 600,000, they want to pull cash out. So now most lenders are going to want seasoning. You want to pull out the cash, we're going to base it off the 400. That's what you bought it for. How do you guys underwrite? And without it having to be some delayed financing and you got 6 months, like on the agency side, how do you guys look at that?
Sure. Good question. I mean, this is one of our favorites. So again, common sense lending. That's what we do here. So we don't have seasoning requirements, but we're going to take a common sense approach to everything. So my first question to you is, why is this customer so smart that they were able to acquire this house? So just understanding that they're a professional investor, or that they had an opportunity, they paid cash for their neighbor's property that was going to be sold, and they had a long-term relationship. So just understanding how they acquired the property at one level is fundamentally important to us. Right. But what I would also suggest to you is that if they're doing any rehabilitation work to the loan, I always prefer to take the happy path. To me, the happy path is providing that work to the appraiser. Let the appraiser incorporate some of that information into the appraisal so that we have third-party validation in terms of what work has been done, so that they can explain the work, which helps validate the new value. And then, of course, we're looking for a good appraisal. So if we've got a good appraisal, we understand how the customer acquired the property, it makes sense to us. We're going to give you the cash out. We're going to give it to you at the max LTVs that we offer. We're going to offer the appraised value, and we'll be on to the next.
Yeah. So this is I have to assume, not taking the right time and having the conversation with you to go over that stuff up front could really make this more difficult for a loan officer, right? If a loan officer just doesn't have their story, doesn't have all the details in place, because that is a real risk in the non-QM space, equity stripping, and the fact that maybe getting some bad apples kind of spoil the whole bunch for us all. So what would you say that a loan officer should do if they have a scenario where they have increased equity in a newly acquired property without seasoning? Do you think they should give you guys a call and just talk through it first before just throwing it in and just seeing what might happen?
Yeah, I mean, to your point, we need to protect our industry. We need to protect our organizations. We need to do the right thing for the customer and for and just as importantly, we need to make sure that we have good loans that are going to perform over the long run, so that we have these opportunities to earn to solve and earn livings on a long-term basis. So what I would say is, whenever you're having a no seasoning loan, you have to email, text, or call us. We have to have a conversation with you. You got to give us the opportunity to walk you through that loan. The loan can't have weakness anywhere at that point. When you're dealing with a no seasoning loan, the way that you discussed it, to your point, the devil is in the details. We really need to understand what's going on there. We want to make sure it's a solid loan. We want to make sure it's a good loan. There shouldn't be any other weakness. When I'm dealing with a loan and I have an under 6 month seasoning issue, if you think that you're going to ask for an exception when you have an under 6 month seasoning, you'll be disappointed. You're not going to get exceptions. And by the way, we take great pride in exceptions in this industry and within Champions. So lots of loans that we do are going to violate our guidelines. We're going to make exceptions on those loans. There are going to be certain types of loans that we won't make exceptions on. This is a perfect example of that. We want a good quality loan in every way when there's this lack of seasoning. So
it makes sense. That makes total sense. So,
just calling and talking to us will always allow us to vet out the problem, so that you're going to look like a winner because you've identified an opportunity and we've provided you with a solution. The worst thing you can do is not call us, and then we haven't vetted it, and then we uncover that ugly thing, 2 weeks later, and then you look, you don't look as professional as you want to. So having the conversation with us is absolutely key so that we can help proactively identify problems before they occur.
No, that's helpful. Thank you for that. So I got another one. This one we've talked about a lot of pieces of this scenario. So an adult child lives at home, rent free, wants to buy an investment property using DSCR for calculating the rent and the income. Needs to use gifts from his family. So, DSCR, gifts, rent free. Let's just say it's $1 million purchase. What are you thinking? You thinking this is something you guys can get your arms around? You think this is something that they can get back to their agent and say confidently, "Hey, I got a home for this in Champions"? What do you think, Kenny?
I'm thinking that, what I tell my children all the time, which is that just because you graduate from high school doesn't mean you get to go to college. Okay. So the reality is we can do all of the things that you're describing here, but we cannot always do everything together all the time. So an adult child living at home that wants to buy an investment property using a DSCR, gift funds allowed, and using gift funds, which is allowed to your point,
right.
And the loan amount is under $1.5 million, and there are no reserves required. That's all factual, and we can do all of that. But when they're living rent free, and you have all of these other components, that's something that you might run into a problem with. So the living rent free with family, for example, we allow it. It's underwriter discretion, and it's based on the quality of the overall loan. Right. So if you were to tell me that they're living at home, but they're making payments to mom and dad, and you can prove it to me, and it doesn't have to be a lot of money, right? It's more about the fact that they're able to make a payment. That will go a long way.
Or if they have their own reserves, right? I mean, I'm just, you have to assume if they're not paying rent, then they should have some reserves, and maybe there is some exception grounds there, right? Yep. Strong FICO score, maybe they've been paying a bunch of other debts on time for years.
Yep. This might
rented a year ago.
Be one of those times where the co-borrower comes into play.
Right.
And what I'm hearing is if they're living at home with mom and dad, and mom and dad are giving them the money to buy this property,
right?
I'll have lots of questions for that. Is it, maybe mom and dad want to just go on as a co-signer for you,
right? So they're putting the money out anyway. Maybe protect their gifts or their investment in their child.
Right. Right. Protect their own investment. Right. Yeah. So I think that, to your point, like, we can do all of these things, but sometimes you can't do everything. And it's really important to know that our job sometimes means that we have to say no. We try not to. We're always going to try to provide alternatives, but we can't do every loan all the time, although sometimes we think we can. But what we are going to do is provide options. We're always going to provide solutions, and then hopefully there's a solution in there that is functional. So I would suggest to you that with the living rent free with family on an investment property loan, we're going to look for some other compensating factors many times to make us feel a little bit better about it.
I was trying to give you things you just say yes to, but I knew I made that one hard. I knew I was like, let me just see. Maybe my son's 25. Maybe he wants to buy something.
Listen, why not?
He fit that mold real well. So, all right, let me get you another one. This one I'm not going to be so. I'm not going to try to trip you here. So this has to do with large deposits and sourcing funds.
Yeah.
So a client's got a $500,000 large deposit that he can't document.
Yep.
What would Champion solution to be in this situation? Rather than telling them, "Hey, you're done. We can't do anything ever." What would you think would be a good advice that this loan officer would give based off of what you know about credit policy and things over at Champion?
Sure. The first thing I'm going to tell them to do is just give us a phone call, because everything is solved through understanding the uniqueness of every customer and their story. So my first question is going to be, are they self-employed?
Right.
Right. So if there's large deposits, for example, and if it's in a business account, well, then just show me that those large deposits are from doing business. They closed a deal. Show us the bill.
And don't be scared, right? Don't be scared of, just talk about it. Be honest. Let's talk through
it. The best thing that they can do is talk to us, because we are an extension of the loan officer. We are a loan officer's partner. It is a partnership. It is really, the relationship is that pure. Okay. Our job is to provide good, honest information that we know is going to put the loan officer in the best light. Ensure that we're providing quality product to quality customers that are going to perform and put everybody else in the best of light. So being honest with us is the best thing, so that we can provide solutions. Because what I have found is the honest answers typically work the best. So if I know that they're self-employed, show me they're self-employed. Show me the accounts. Not a problem. If the large deposits are monies that they got from family members, well, then that's a gift by every other definition. So just set it up as a gift, because we allow for 100% gift. If it turns out that, it's just an unsubstantiated large deposit and they can't define it, explain it, or prove it, then we have another wonderful solution, which is the 30-day seasoning rule. And I don't know anybody else that's doing it. No. So we're going to take a very unique approach, 30-day seasoning prior to closing. So what does that look like? Customer put $1 million into their account. We have no way to know what it is. They put that money into that account 20 days ago. You submitted the loan to us. We approved the loan. We see the large deposit. We're telling you that we need you to explain where that large deposit came from. 15 days later, we've moved into a new month. The money is in the account. Show me the new bank statement. Show me the money is in that account 30 days. Now, it's 30 days prior to closing, not 30 days prior to contract or 30 days prior to application. It's 30 days prior to closing. So they could move the money into the accounts. The money can sit there. It just has to sit there for 30 days prior to closing. Give us that account, show us the money is there, and then it's considered seasoned money and we can use it with no question.
Yeah. Wow. That's incredible. So, one of the things that I heard you say, and it's definitely, I think there's only you and one other company that even offer this, and that's that Ally product, right?
Yeah.
And that I would think is sometimes the only solution for people, right? In some situations, that's it. That's all you got. But I have to assume that not all loans start there, right? Because the rate's a little bit higher from my experience, right? And maybe a little bit lower leverage depending on the FICO scores and all. You might be able to get a little higher with some of the other products. But at what point do you think a loan officer should shift for the borrower's best interest, on any type of loan, bank statement, DSCR, things like that? Like, when do you think, hey, you know what, just stay here, come here first. Let's avoid the headache. Let's avoid all the pain you might go through.
Right. I mean, that's a tough one, right? Because it's like, ultimately our job is to do what's in the best interest of the customer. And that's going to make sure that we're going to give them a loan that they deserve, that they qualify for, that they can pay, that's going to protect all parties involved. And so sometimes, and a lot of that comes from conversation with the customer. What are their sensitivity points? Their sensitivity points could be rate. Their sensitivity could be fees. Their sensitivity could be speed. There's right to closing. Their sensitivity could be, I'm not willing to provide certain documentation that you want to make a debt to income ratio loan. So there's a variety of things that will impact what that looks like. But what I have seen historically is that a lot of customers will call and they'll come to us for a primary residence no ratio loan. And then, and whenever they do that, my first basic question is, well, how are they going to make the mortgage payments? Like they're looking for $1 million loan and you want to do a no income check. How are they going to make those loan payments? And based on those comments, that helps me understand who they are, what's going on. And that allows me to make some very quick decisions. They're recently retired. Their money is in assets, right? So that's how they're going to make the payments. So maybe an Ally loan works. Maybe an asset depletion works for that customer.
Right.
Maybe they don't qualify for the asset depletion because of where their money is sitting, and it doesn't allow them to work. So the Ally product's the only option. Maybe they're self-employed, so we offer them a bank statement or P&L as an alternative. And it turns out that they've only been self-employed for less than 2 years, or they own less than 25% of the business, or some other restrictions that make it so that those DTI loans don't work for them at that moment. So, understanding the complexity of the loan, understanding what's going on there, that will determine that feature. If there's some uniqueness to the customer or to the program, right? Rural properties will do. On these primary and second homes on these Ally programs up to 20 acres, which is a great feature. We're going to allow first-time home buyer on these Ally programs with only 2 months pity reserves. So that's another reason why we might see somebody go to the Ally program, because they don't have the reserves for a traditional, for a bank statement loan, which may be at 3 or 6 months reserves, and they don't have it. So there's a variety of reasons in which the Ally no income check may actually be the right loan program. Sometimes, right? So there's so many different reasons, and ultimately it's just going to come down to the questions and the specifics to that particular loan customer borrower.
No, yeah, I mean, so and what's interesting is what I heard you say multiple times without maybe even directly saying it is you want to make sure the borrower is getting the best deal, right? Like you want to say, hey, could they get a better deal interest rate wise, closing costs wise? Are we just being lazy? Let's not be lazy if we can document something that's going to give the borrower a better deal. So
we always want to give the customer the best deal that we can under those conditions. Sometimes the best deal is the best interest rate, and sometimes it's not, right? And that's just going to depend on the uniqueness of the customer. So we really, again, it's that holistic approach. Tell us the story of your customer. Tell us, like, a lot of the times a customer comes to us and it's a fire sale, right? We're not, they tried to get it done through Fannie and Freddie. They pushed and they can't get it done. Then they and by the time that we see it, you've got 2 weeks left. You got 3 weeks left. You don't have much time. So that means that speed is the most important issue, and that will dictate what we do on a loan. So
I got one more for you, and this one I think is something that I don't think I've seen many other non-QM investors that will operate in this space. So this is an under-rented property, right? Yeah. So we got a DSCR loan, and the home is currently leased for $2,500. Maybe it's been to the same person for the last 10 years. This little old sweet lady with her kids, and you're a good landlord. You keep it at $2,500. When you get your appraisal, the 1007 comes back and says, "Hey, market rent's $3,500." So what are my options, right? I need to maximize whatever need I have. I'm trying to pull cash out. I'm trying to get whatever need I have as the borrower and the landlord. The only thing I could think of is get a new lease, make this lady pay more, but that's the only way I can have access to my capital, to my equity. What other alternative solutions do you think does Champions have?
That's a good one. We love that one because these are the areas that we win where other people can't. So to your point, what we would do with a customer that is under renting compared to what the market rent is, we will always go off of the higher of the two. So we'll go off of the market rent, the 1007 in that case, no questions asked. There's no LTV exceptions. There's no pricing adjusters. We're going to treat it like business as usual. And that's it. And we're just going to simply go off of the market rent, even though the market rent is substantially higher than the actual rent that they're collecting. So that's an option for you. Another option that we see a lot of the time on a purchase, where we see that the property is being under rented. We identify when we speak to the buyer. The buyer tells our loan officer that yes, we know it's under rented. The customer has already committed to coming up to actually above market rents for a variety of reasons. And it could be because the property is an up and coming market. It could be that it's slightly larger than what's normally in the marketplace, so it actually can rent for more than the marketplace. There's a variety of different reasons that may or may not show up. And so what we're going to allow you to do is fix that loan very quickly. So we're one of very few that will allow you to collect a brand new lease, security and first payment, and then go off of that as opposed to the market rent. So your market rent in that case was $3,500, but they want to pay $4,000 because that's what they need to pay to keep the property. We're going to go off of that as well. So we're going to give you that flexibility. Another thing that we see a lot of is that a lot of the times our DSCR loans, they start DSCR like almost all investor loans. And then for a variety of reasons, we're going to flip it to a DTI loan. Why do we flip them to DTI loans? Well, the reason we'll flip a DSCR loan to a DTI is if they're looking for a certain LTV, maybe they want an 80 or an 85 LTV and the DSCR ratio just won't work. So we'll flip it to a P&L or a bank statement loan or something like that. Maybe they're looking for cash out. Our DSCR loans are actually very aggressive on the cash outs because under 65 LTV, we go to $1 million. And above 65, we'll go to 600,000 all cash in hand. But a lot of times customers need significantly more than that. They need $1.5 million. They need $2 million. We had a customer that was doing an investor cash out. They had no mortgage on the property. It was worth $2.5 million. They wanted as much cash as possible. We got them $1.5 million loan at a 65 LTV doing a DTI loan where they were capped only at $1 million. So cash out is a big reason they may flip to that product as well. So there's a variety of different reasons, but the point I'm sharing with you is we can always fix a loan as it's moving through the system. So if they identify a need or identify a new need or something changes along the way, so whether it's a DSCR loan going off of the market rents, above market rents, flipping it to a DTI loan, you can even do a investor no ratio if you really wanted to. We have very little need for them anymore based on the amount of product line that we have, but it's always nice to know that you have that as well.
Again, this is where the drinking out of a fire hose comes, right? So call, text, email Kenny or your local point of contact because there's just a lot. There's a lot there. That's awesome. All right, so we're winding down, but I want to, you mentioned rural and agricultural zoning, and that's something that I get asked from some of our sales folks. I see it in our group chat where they're asking questions about, can you do a farm or can you do this property? It's got 50 acres. So what are the things that to get comfortable with rural properties at Champions? Because I know you do offer something that others mostly don't. So I just want to kind of narrow that down for some loan officers as to what are we talking about that's actually viable?
Sure. It's a great question. So the down the fairway conversation on that is our Ally program. Okay. Our Ally program does rural properties straight up, no questions asked. It's within the guidelines. Obviously it's got to appraise and meet all the normal good stuff on an appraisal, but second home, rural property, no income check. That's a very, very strong program. Second, primary residence, no income rural property, also a really great product on the Ally. But where we see it quite often, most often, is on that Ally second home. But the other place that we see it is on the investor side. So on the when you're dealing with investor programs in the investor world, generically speaking, rural properties are flat out not allowed, right? Yeah. Can't do DSCR loans in the investor world that are rural. And what we do is we take a very common sense approach and we say, listen, just because a property is zoned rural, that doesn't mean that it is rural. A rural property has rural characteristics. A suburban property has suburban characteristics. Part of solutions-based lending, which is what we do, is we're going to look at and dig into that information. And so there are characteristics on a rural property many times that are actually even though it's zoned rural, it's got the suburban characteristics. So we'll look at that appraisal. We'll talk with the customers. We'll understand there's certain data points on an appraisal that we quickly can look at. So for example, if the land use on the property is 25% or more, even though it's zoned rural, that fits the suburban characteristics. If the comps are less than 5 miles, even though the property may be zoned rural, that meets the characteristics of suburban. And so we might look at that loan as a suburban loan, price it as a suburban loan, no LTV, LLPA adjusters, and it gives us a really nice, unique opportunity to look at loans. I think another place that we're doing that quite intelligently is on agricultural areas. So there's no confusion. We cannot do agricultural properties. We can't do farms. We can't do any of those good things. But what we can do is we're very smart to understand that many times properties are zoned agricultural, but they're duly zoned. So they have multi-zoning components where the property can be agricultural, but it can also be residential.
Mm-hmm.
And so as long as it can be used residential, and the appraiser backs up that it's its highest and best use and still makes sense, we'll use that loan as residential, even though it's zoned agricultural. So we'll take those common sense approaches. We'll look at the appraisals for the customers. We'll do all of that. We're not going to ask them to make those judgment calls. We will walk every loan officer through it to figure out those solutions.
Got it. No, so I want to shift. So the other thing I heard you say, and this will be really the last product specific, then I just really would love to kind of wrap up with, how to talk to and how to work with the credit department. So moving away from rural and, maybe back into the suburbs and into the urban area, right? I heard you say mixed use, right? I heard you say single family homes with, maybe a doctor's office in it. Maybe it's a daycare. My chiropractor from 5 years ago used to be in his house, right? He'd be in the basement or the split level, and then above that was where his kids and his wife were. So someone like that, I remember having to try to go to like FHA, and you need to get the appraisal, and 51% of the square feet has to be for the residential piece. What's the highest and best use in Champion's world for someone in this type of situation?
Yeah, thanks for that. That's a good one. So, our Ally program, like I said, it's a very flexible no-income program. So not only is it a no-income program, but it's got this mixed-use component that you're talking about. So we can take any single-family residence where a customer is actively using it as a single-family residence, and they could be running a doctor's office, a chiropractic. They could be a daycare center. We've seen them where they have a barber shop in there. All of those components. Some people have senior daycare centers. We think of daycare centers just for children, but we see senior daycare centers work with people working out of their homes in those facilities as well. All of those different types of mixed use opportunities can be used to qualify on this no income loan program. Again, and rural properties, it could be rural, it could be suburban, it's irrelevant. It's just a matter of making it work. So we've got those unique things. And again, they could be a first-time home buyer purchasing a property that's got a doctor's office in there, and they plan on using it as a doctor's office because they're doctors. Great. We'll do it.
It's a helpful way so they don't have to just buy it with cash, right? Because alternatively, that's probably what they think is the barrier. That's the only option they have.
Yep.
All right. So now I would love to learn this, somewhat self-serving for me, as well as I'm sure the audience of loan officers that want to, get their loans to go through, friction-free. What are things that give a couple of things that loan officers can do so that when that underwriter picks up that file, they're like, you know what, this loan officer knows what they're putting together. This loan officer understands our products. This loan officer understands how to package this loan up so my job is just easier. So what are some recommendations you make there?
Well, look, I mean, the best answer I can give, especially if it's a loan officer that hasn't submitted loans to us before, and even if they have, the best answer is to call us, talk to us about the loan. Our job, that by definition, Gabe, that's our job. Our job is to listen to what the scenario is and guide the loan officer, whether they've got a ton of experience or not. Let us ask the questions that we know are most relevant to your loan. We're going to ask the questions that are 2 or 3 weeks down the line. We're going to ask those questions to the loan officer up front so that they can proactively address those things. So whether it's getting whether it's addressing the assets in the file, or getting proof of rent payments on a loan, or fixing credit, or letting us calculate the bank statements long before the loan is submitted, and then giving us the opportunity to help you get more income out of that loan. Those are the types of things that we're trying to understand so that we can round off all the edges for that loan in advance. And again, if a customer is relatively new or they're uncomfortable with anything, besides email, texting, calling, giving us the chance to talk to them about the loan on submission, but we also recommend, just as important, is let's go over the loan approval. Let's make sure that you understand the questions that our underwriter has, and let's make sure that you know how to respond to the questions of your customer based on the uniqueness of the guidelines that we have. Because many times the conditions that we have are going to be different than a loan officer may have ever seen if they've only been doing Fannie and Freddie loans, because Fannie and Freddie loans have Fannie and Freddie conditions on them all the time.
Right.
And we're going to have conditions that are specific to what we have because it's the uniqueness of the loan. So the best thing that I can say to any customer is to email, text, or call, leverage the skill sets that we have, which is let us round off the edges and get you moving in the right direction.
All right. So the last 2 questions, and this has been an absolute pleasure, Kenny.
It's always fun to talk to you.
Yeah, man. I just feel like the stuff that you have brought and the team has developed over at Champions, in my opinion, is a big separator. So I love these last 2 questions just because I feel like every loan officer wants to know what advice would you give for a loan officer to go get their first 3 non-QM deals? Where do they go? Who do they talk to?
I would say the first thing that they have to do is be honest with themselves, and they have to ask themselves how they're getting business today.
Okay.
So, for example, if their business is being done via referrals, what's their referral partners? Are they accountants and CPAs? Because if they are, we've got a phenomenal asset depletion program and a great P&L and bank statement program. Those accountants and financial professionals are looking to always maximize value to their customers. And what's really unique in this conversation that we should realize is a lot of financial professionals don't necessarily want to always refer their customers to a mortgage bank. They'd much rather refer them to a Wells Fargo. Hate to say it, but it's true, right? Because, a Wells Fargo is Wells Fargo. So it's a nice, easy, safe referral. Exactly. Yeah. But you can't refer my customer to a Wells Fargo.
Right.
Not an option. So that's a great way for you to win those referrals without having any additional, risk to the account,
to that relationship. To that
there you go. So that's another interesting thing. If you told me they're realtors, I'd say great. Let's focus on the fact that we could do 100% gift. First time home buyer. I would say focus on doing a quick, PowerPoint presentation. One of the things that we do is a lot of education. So we can show you our PowerPoints. We can do those PowerPoint presentations, and then you can take them and you could turn them into customizable documents for yourself. We're happy to let you do that and would encourage that. If your customer is buying leads, well, heck, in many cases, that's the easiest thing to do because our products are so unique that you could start fishing specifically for customers that only we're solving for. Right. So let's just take the Ally program. Let's just say you get very unique. You could market to any realtor that's selling daycare center properties, right? Or any customer that is a builder that's doing luxury log cabins. Very unique, but we do them, right? Customers that are dealing with seniors, right? Reverse mortgage customers, reverse mortgage loan officers, reverse mortgage customers. Our Ally program is phenomenal senior lending alternative to the customers that don't qualify for reverse mortgages. When 2 out of 10 customers qualify or get a reverse mortgage, what are you doing with the other 8 opportunities? Our Ally no income product is a great solution for that. Yeah. So understanding the uniqueness of the product, we can show your customers, your loan officers, how to buy leads, how to acquire leads, how to market for those specific things and win. First-time home buyer. I'm the only guy in town that's going to give you a first-time home buyer no income check on a 1 through 4 property with only 2 months pity reserves. So we have all of these. So it's what I try to tell people is this. You're calling me because of the solutions that I have, okay? The uniqueness that I have. This is a very difficult world we all live in. I don't want somebody calling me about a VA loan. Anybody can do a VA loan. I want somebody to think of Kenny Peskin and think of non-QM and a loan that needs to be thought about. That's my solution. That's me. And that's how I take a commoditized world and make it not commoditized. And I maximize my value. And what I'm saying is every loan officer out there should be doing the exact same thing.
You know, it's almost ironic or just kind of funny in that statement you made about a VA loan. I find a VA loan more difficult than a non-QM loan, right? All the residual income, child care. I mean, it's the appraisals and the timing. And I mean, it's just, I find VAs to be a little bit more difficult than non-QM. So I agree. I'd rather talk about this stuff personally. I mean, nothing against, I'd love to support our veterans, but these programs can support veterans as well. They can qualify for some of the non-QM stuff in that space as well. But Kenny, again, man, this is a pleasure. Anytime I can get an hour and a half with you and just shoot the talk here and connect. One thing I heard you say more than any other 3 words that came out of your mouth, and maybe it's more than 3, but that was email, call, text.
That's right.
And, so if you're a loan officer listening today, your assignment's really simple. Find out one file in your pipeline that maybe doesn't fit conventional. Maybe you're running into some trouble because of seasoning or because of reserves or gift funds or whatever, situation you may have. And run it through Champions. Run it through Kenny and his team. Let's utilize him. Let's get him to kind of deliver on that. Call him, email him, text him, and really find a solution, right? That solution-based lending. So, again, I couldn't thank you enough, man. This has been a lot of fun. I'm looking forward to continue to see how Champions continues to adapt, evolve, and identify additional low-risk spots, right? Where maybe some of the competitors haven't seen it yet. They haven't realized the opportunity there. Where you guys are going to continue to fill those gaps. And then, of course, that straight down the fairway stuff. I don't want it to be forgotten that Champions can excel on that as well. And, if anybody takes away anything from this, it's just reach out to Kenny. Let him see what he can do, see what kind of magic they can pull to find a way, to look at your loan a little differently. And that's what we're looking to do. We're looking to try to make impact and add to the loan officers' lives here by giving them a place here with the Altyverse to get your answers, find out, learn, and make yourself that much more, dynamic and dangerous out there to differentiate yourself against your other competitors out there. So thanks again, Kenny. Appreciate you, brother. And look forward to having you back again soon, man.
Looking forward to it, Gabe. As always, it's so much fun talking to you. So it's great catching up, and I appreciate the time. It's been wonderful.
Right. Thanks, brother.
Have a great day, man.